are looking good, not obese for Indian markets. 42 points higher for the Nifty. The market breadth, grand open, sir. 1:5. I like to see such market breadth when the market breadth is almost near perfect. Is State Bank of India bouncing back? Now that's for me is more like a mystery that there was nothing wrong with the numbers. It is. Should ITC also bounce back? Well, brokerages are saying yes. So it will see a rub-off effect. But in terms of end strength, no, it is not. So what we were discussing, Anisha Avan, in the morning, that the chances of State Bank of India bouncing back versus ITC, I think State Bank of India will bounce back. State Bank of India comes back, the Bank Nifty makes a comeback. The Bank Nifty makes a comeback, Nifty will have an extra fillip. So it's all tied up very nicely, like a string with pearls in it. SBI moves, Bank Nifty moves, markets move higher, a breakout could happen. I'm making it sound simple, but I think SBI could be the pivot stock for the day.
SBI might be the pivot stock, and for now it's definitely showing signs of that, 1.3% higher. But within the broader markets, a lot of result reactions. Let's pull up Gland Pharma. That's seeing a dropping of almost 12%. The stock has collapsed quite a bit already, but still at around 1200 levels for that particular counter. On the gaining side, however, there's GR Infrastructure up 7%. Ramco Cements is reacting to its numbers. Let's also put up Bata India as well as Indigo. They were largely in line to a better than expected numbers. Let's see what the result reaction is on that one. And even Indigo, for that matter, that stock was also expected to show a positive stance. Let's see whether that has worked out. Greed and Fear has managed to add Thermax into their portfolio, so there should be a positive reaction to that. Nazara Tech is something that we are watching out for. So a lot of result reactions really to deal with. But you also have Sirma SGS. That's something that we should pull up because that stock managed to report a very, very strong set of numbers. Is there an appropriate reaction coming in on the stock price as well? Just 2% higher. Maybe the street was factoring in a lot already. United Spirits is one stock, and then the AMC stocks, of course. So HDFC AMC is something that we should pull up. Aditya Birla AMC is something that we should pull up. Yes, these stocks are reacting negatively given the fact that Sebi is coming out with a slew of changes that might impact their profitability. Concor and other result reactions. You also have Minda as well as Thomas Cook, which is something that we are seeing in terms of result reactions. PI Industries as well as Tata Elxsi. These are some of the counters that you need to have on your radar. Thomas Cook is reacting negatively. PI is high by around 1.25%. And then Tata Elxsi, as we were anticipating, it's seeing a bit of a downtick. 3% cut. Remember, the earnings were tepid, and the fact that the stock still trades at very expensive valuation is something which is not working out well for the company. But for the Nifty Avan, it's a decent opening, 18,150. We're not seeing that 18,200 level yet, but not too bad, at least an opening in the green.
I wonder if Kunal agrees with that. What's your outlook, Kunal? The fact that we're around the 18,150 mark, would you have expected a further scale up? And of course, what's the first trade you're punching in?
No, I expect a consolidation, and I think it's a good sign that the markets are trying to digest because there is so much happening across the globe in terms of events, many of the indices breaking out. The only concern with the index is dollar index still at 103.5 levels. That's the only concern with respect to the correlation. But net, I would still believe that the indices consolidate over here is a good sign. The stock which I would look to trade in the open would be on IEX. Very good recovery for the stock in the last 2 or 3 days from 153 levels to 160 where it tested yesterday. So I think at 159.60 levels looks attractive for a contra buy.
Pankaj Tibrewal joins us. Let's take a conversation forward. The Senior Vice President and Fund Manager with the Kotak Mutual Fund. Good morning, Pankaj Bhai. Kaise ho? I always get to see you when markets are strong.
That's a problem that last 18 months markets have not been gone anywhere, but we have been meeting. So
we've been meeting not on television. We've been meeting as friends. But I only get to see you more often on television when markets are making a new high. It's a good issue to have. I mean, now that markets are making a new high, we should see you more often.
We are always there when the markets are bad also to handle investors and others.
What's your view right now? I mean, do you think this market, which has rediscovered momentum, where things are falling in place for macros also, this market now has a strong case to outperform, and bulls who are back, they are here to stay?
Nikunj bhai, we have always believed that markets are slave of earnings from a medium to long term. In the short term, liquidity sentiment can play their own role. So it's very important for us to decode the earning season which is going on. Till yesterday, Nikunj bhai, about 294 companies out of the NSE 500 companies have reported their numbers. And some interesting trends are to be watched out. Out of these 294 companies, 63 are BFSI companies, and 231 companies are non-banking and financial services companies. In the first 9 months, December ending, we saw a huge pressure on the non-BFSI space because margins were under pressure. This quarter, there is a very interesting trend that we have seen a quarter-on-quarter strong recovery. And my sense is that margins are at 8-quarter high. And non-BFSI space has shown 3.3% earnings growth, the 231 companies. In the first 9 months, the BFSI space led the entire show with almost 50% earnings growth. That is seeing moderation, and the BFSI 63 companies have shown about 21% earnings growth. So on an aggregate basis, we have seen 9% earnings growth, which is better than the first 9 months, which we saw. So there is some momentum which is being seen on the non-BFSI space as far as margin expansion is concerned. Coming to Nifty companies, about 35 companies have reported, and the earnings growth is about 14%, which is slightly better than what the street was expecting. And the entire show and the growth is led by BFSI as well as autos to a certain extent. And in many pockets, we have seen some of the oil and gas companies also delivering strong numbers. So I believe that compared to what we saw in the first 9 months, there has been some improvement across the broader space. And I think market has started to reflect that. The second part is on liquidity. I think market has been surprised by the comeback of FIs in a very strong way. Also, we believe that the next 6 to 12 months could be very strong from FI flow perspective, because what we are experiencing as a fund house is that over the last few months, many new FIs whom we have not seen, they are looking and doing their homework on a country-specific allocation, which is India. And I think over a period of time, if market remains in a consolidation phase, valuations have corrected over the last 18 months, it will give a good entry point to a lot of investors who are looking at India specifically from a longer term perspective. So from a FI flow perspective, we are not so negative. We believe that April could be a curtain raiser for the next 12 to 18 months from a FI perspective. Domestic flows continues to be strong. And also don't forget, over the last 4 months, we saw the dollar index sliding down from 113 to 102. And there is a negative opposite inverse correlation of dollar index versus Indian markets. And whenever we have seen dollar index slipping down, actually it bodes well for the Indian markets, which has been the case over the last 1.5 months. So our overall view is that in the next 6 months, whatever bad news needs to come out, either in form of monsoon news, global volatility, US debt ceiling, US interest rates going for a long pause, all those things will play out. And I think the second half of the fiscal year could come out as very strong. And this next 6 months, what we are advising investors is the allocation phase. Start allocating and increasing your equity allocations for 2024 and 25.
Okay, so that's the take coming in, start increasing your allocation. But I was just going through the top, holdings that you have, and it seems like you have a lot of the capital good names in your portfolio as well, right? From a Cummins to a Carborundum Universal, which is a bearings play, etc. What's your entire thesis around manufacturing? What are the top stocks that you like?
So we have been vocal about this theme for last couple of years. We believe that there is a revival of entire manufacturing space in India, and capital goods is a great proxy to play that recovery. Across the sectors, not only say chemicals or electronics, but we are seeing traction across many other industries, for example, gas utilities, cement, steel. So a large part of manufacturing is something which we are seeing a very strong revival for. Just to put things in perspective, 5-6 years back, the total capex of India, which is state, center, and private, used to be in the tune of 10 to 11 lakh crores. And this year, on a trailing 12 months basis, we have already crossed 20 lakh crores. So we have seen over the last 5-6 years that center and state have done the heavy lifting, and we are seeing early signs of private sector capex also coming back. We used to be 4.5-5 lakh crores by private sector capex for a very long period of time. This has crossed 7 lakh crores on a trailing 12-month basis. So these are some interesting trends which we are seeing, and probably this time it's not a false alarm, and hence we are expressing our view in the entire revival in capex and manufacturing through many of the short cycle plays, maybe bearing, maybe abrasives, and so on and so forth. And also on the other side, we have some of the manufacturing names across various industries. So that's how we are, kind of bullish on this space. And China Plus One and defense are realities which are happening right in front of us. Companies after companies are looking to diversify their supply chains. And on the electronic side, we are seeing the kind of momentum which is starting to build up at the ground level, starting with mobile phones, going on to air conditioning and many other parts led by the PLI.
Pankaj, morning. Now, you have said that it's a good time to increase exposure over the next 6 to 8 months. So identify for us which are those pockets in which you are increasing exposure.
So clearly one which we spoke about just now, the entire manufacturing sector. The other is the private sector financials. The numbers have been quite supportive. Valuations are also reasonable. And I think this year, the returns on banks and financial services should be a reflection of earnings growth. We are not banking upon any expansion on multiples, either on the price to book or P. And earnings growth reflection should be seen on the stock prices. The second one is also a dark horse called pharma. Initial signs of the companies reported, but stock specifically, we are seeing improvement in US geography, which was under pressure for last 4-5 years. The price erosion, which used to be about 10 to 12%, has come down between 5 to 7%. So can FY24 be a dark horse for pharma? We have to evaluate, but I think this space has also started to look interesting. The third is that as a style, if you look at value has done very well over the last 15 to 18 months. We have started to see early indication where we believe that value as a style has started to peak out versus growth. And in our view, over the next 6 to 12 months, growth at reasonable price should be a style to bet on. And many of the companies which were not doing well, either maybe in consumption space or consumer discretionary space, and the numbers have been quite strong for many of those, which are leaders in their categories, should also start seeing momentum catching back again. So these are the spaces where we are looking at. IT, we believe that there will be 1 or 2 more quarters of pain before they bottom out on the earnings side. And that is the time we'll reevaluate on the IT sector.
Right. How much of the good news about a strong credit cycle and low NPAs is something which banks and financials are already pricing in? Because it's like a consensus view that banks are in a good cycle. And when there is a consensus view, then there is hardly any gains left on the table.
That's what Nikunj I said, that incrementally what you are saying is absolutely right, that a lot of good news seems to be priced in. And that's why we are not saying that expect any big expansion on multiples. But our sense is that if the banking sector delivers between 15 to 20% earnings growth, it still will be better than the overall market earnings growth. And hence stocks should remain bidded. And you should see stock returns being more a reflection of earnings growth rather than P expansion. And I think in the environment we are in today, clearly the non-BFSI segment is still not moving into double-digit earnings growth. Even in this quarter, we saw 3.3% earnings growth for the 231 non-BFSI companies reported. This number was negative 11% for the last 9 months in this fiscal year 23. So clearly, if we see opportunities emerging on the non-BFSI space, then a part of the capital will be reallocated from BFSI to non-BFSI. But as we speak today, I think BFSI space valuations are not very expensive out of that. And I think this space should remain bidded in times to come as well. But earnings moderation will definitely happen. And hence, the return expectation should not be what we saw in the last 12 months, but should be more moderated as we move towards the FY24 end.
The earnings expectation should be a bit more moderated, but Pankaj, I don't see any auto name in your top stock holdings or the preferred stock, preferred sector list. Why is that?
So we are playing auto through auto ancillaries. And especially in the mid and small cap space, if you look at the broader market space, auto ancillary is the larger portion. But however, in our multi-cap, flexi-cap and large cap funds, we are overweight on autos as a sector. And I think that sector is doing reasonably well. Even in this fourth quarter, we have seen decent earnings momentum by the auto sector, both on four-wheelers as well as two-wheelers.
You and just curious about your take on new age tech, given the kind of treatment they've been met with when they listed, and then of course that wake up call, the path to profitability focus. How have you looked at the journey of any of these companies? Would you like to walk us through anything in specific that stood out?
So when most of these companies were getting listed, we were extremely cautious. We couldn't understand how to value these companies, which were not talking about cash flows, which were not talking about profitability. But over a period of time, the entire environment has changed on the cost of capital. Earlier in US, for getting 5%, you used to invest in junk bonds. Today, you can get that 5% through US Treasury. So in the last 15 months, there has been a sea change in the way you approach the cost of capital argument. And that's very relevant from the entire unlisted and the new age tech companies, which always for the last decade or so has seen easy liquidity and zero cost of capital. And for them, burning cash was very easy. We need to see how most of these companies locally and globally transit themselves from a mindset and a DNA perspective to profitability path and cash flow path. A couple of companies in India which got listed in 2021 have already started talking about in their commentary of path to profitability, which is a welcome change. Also, a lot of companies have made earlier mistakes on communication, some of the other issues on capital allocation, and I think they are learning their way out. So at relevant point of time, definitely it's on our radar, and we are evaluating a couple of them which have leadership positions, strong moats. And once we see the unit economics working in our favor and the overall approach of the company is towards cash flows and profitability, we'll definitely have a look. But globally speaking, we are worried that I think the pain in the private space has just yet started. It's still, in the early stage where capital is drying up for for the new age companies which don't have a business model. And I think the next round of funding for a lot of companies which need capital will not be so easy what we saw in the last decade or so. So there could be higher mortality rates we should be prepared of. And if you look at the entire funding in the last 6 to 8 months, there have been very few deals where funds have gone and done the second round or the third round. So the space needs to be approached with a little bit of caution. But in adversity lies opportunity. And we are open-minded that if we get any good company with strong economic moats, we won't like to shy away from them.
All right, appreciate your time. Thanks very much, Pankaj, for joining in. And I just want to identify some result reactions. Man Industries is a stock that's reeling under pressure. Revenues came in flat, 555 crore rupees. The margins as well were flat, and the net profit at about 27 crores. But that's the stock which is down and out in trade today. Meantime, there's some other candidates as well. You've got something like Tata Elxsi as well, which came out with its quarterly numbers post-market hours. 838 crore rupee PAT is what the company delivered, and an EBIT at about 229 crores, absolutely flat, but clearly the street not taking to it very kindly. Meantime, you also had something like United Spirits. There was a margin contraction in the quarter gone by to about 13.5%. So that stock as well is under a bit of pressure in trade, and profits coming in at about 204 crore rupees. Interglobe Aviation, another result reaction with a 916 crore rupee PAT. That was down about that was down on a sequential basis. And of course, you can see the result reaction of SBI and ITC playing out. Let's move right on then. Irfan Razak, he is the Chairman Managing Director at the Prestige Group, joins in to talk about what's going on in real estate, high interest rates, pricing, and so much more. Thank you so much for taking time out. Now, after several years, that bounce back is very evident in the real estate space. I just want to understand what you're experiencing on ground. Do you see this momentum continuing? What are some of the lead indicators that you believe will support this?
Good morning. Yes, you rightly said, the mood is good. People are committing themselves. There's a lot of demand. And I think it's basically because the pent-up demand was there right from the beginning. And now people have realized that they need to buy the house. There's a need. And that need is being fulfilled with good products. Of course, the product has to be good. The location has to be good. And at the same time, we have to make sure even the pricing is absolutely right. So if we get that mix right, I believe that business will go on. And but the traction on ground is excellent. I think the demand is continuing, not only in Bangalore, but in all the cities that we operate in, including cities like Mumbai.
There has been an election cycle in state of Karnataka. There is a slowdown which is happening in the IT sector. Startup world is not hiring. Companies are not paying full variable pay. Since you have a large presence in Karnataka and Bangalore, what would be the indirect impact of both these sudden factors at play?
See, I mean, these are something that we can't read just like that. Basically, if you ask me, there is still demand for office space. There's take-up of office space in Bangalore also. And that indirectly or directly means that there is more job creation. There are more jobs that are going to happen because that many seats will be created for the IT space. Or see, if it's not IT, it's ITES. If it's not ITES, it's banking. But some of the other businesses are coming to India, and I think Bangalore, of course, is a preferred pick, along with many of the IT cities that are there, like Pune, Hyderabad, all of the cities that are, even Chennai for that matter. And in all these cities, the leasing is pretty robust in the sense that it's come back to its old things. Especially if you ask me, what happens is that the slowdown that was there during COVID, that has really gone. Then people are coming back to work. You see, now the campuses are full. There was a time when we had a huge campus where 50,000 people used to work or 100,000 people used to work. And at the COVID and post-COVID period, there was hardly anybody. It was a ghost-like feel. But now it's back to its brim. People are going to work, and that's a very good sign. And I believe that is something to do. And of course, now with the political elections and all that being behind us, there'll be a lot more focus on better infrastructure, especially in Bangalore. And I'm sure the new government will try and do whatever they have to do and probably sort of continue with the activities that was there happening for infra.
So we should not connect the slowdown in IT to prestige demand in Bangalore. Do you think they both are independent?
No, I mean, if there's a job loss, yes, there will be. But so far, I don't see that happening. So far, people are pretty confident whether they are working from home or from office on a hybrid model. But it is pretty robust here. That's the indicator that we have on ground. And I think this trend is likely to continue for a few more quarters and maybe build on it because, see, with the world being in the turmoil, a lot more work is going to come towards India. And that is the hope that we are living on because India is probably in terms of delivery, in terms of cost, in terms of everything else, is the best option for anyone else internationally.
I also want to draw your attention to the latest news reports that's doing round, and that's the fact that Karnataka government may plan to hike the property guidance value of the real estate sector by 10 to 30%, and this would mean if the hike is so drastic, there would be a fall in the property market value as well, and this is after the fact that the government earlier had given a rebate, etc., as well on account of COVID-19. What's the probability do you see of this, and what will be the impact on the real estate sector in Karnataka?
No guesses on that. The newly elected government has just come in. They have let them get their bearings. And I don't think any drastic steps will be taken. Yes, wherever there's a correction that's needed, where a guidance value is much lower than the market value, obviously they will do the correction. But I think that's a part of the whole process. And many a time when the guidance value is much higher than the market value, the government has been open and they have reduced the guidance value. So it's an ongoing process, and I wouldn't give too much credence to that.
Look at the global headline, and again, I know I'm comparing different markets here, but there is a lot of stress in global and developed market commercial real estate. That is not the trend in India. Do you think that's not the trend in India?
Yes, because globally, yes, we are also looking at it very, very closely. Internationally, there are a lot of buildings that are vacant, and there are a lot of vacancies internationally. But this is what gives us the confidence. Yes, we won't be going completely out of target, trying to build as much as we can, no. But we will also be doing this in a properly measured way. But at the same time, we are assessing the demand, and based on the demand, we are building. And I believe that the opportunity lost somewhere is an opportunity for us in India. And I think the Indian commercial real estate will sustain as long as they do a good job and deliver a great product.
Could that have an impact on future flows? For example, PE investors, large commercial real estate developers, companies like Blackstone and Brookfield who invested in the real estate sector in India, the commercial real estate sector in India. When their back home investments are drying up, could this have an impact on the fresh investments in the Indian commercial real estate, and that in a sense could create a demand-supply imbalance?
The good news is the Blackstones and the Brookfields and the CPPIBs and all the other PE investors, including JIC, are looking at India big time. They are looking at opportunities all the time, every time. In fact, like you said, we just concluded one large transaction with Blackstone and also a deal with CPPIB. But they are looking at more opportunities. While something would have, some money would have dried up for them in certain pockets, here they are looking for more opportunities. Like currently, even Blackstone did the retail REIT, and I think it's to list today or on Monday, and it got oversubscribed 6.5%. Even our company holds for a 4.3 or 4.4% of that REIT by virtue of not divesting 100% of our portfolio. So that's a thing, and there is a valuation that will come. And these funds are definitely looking at India, and the biggest opportunity for them is here, and that will continue.
Well, yes, you're absolutely right. The Nexus REIT is going to list today, and the indications are it's going to list on the positive side, given the fact that the oversubscription, etc., is something that worked out well. But just wanted to, scratch that point further. When it comes to your retail portfolio, after selling 2/3 of it a few years ago, you're now looking at rebuilding that. Could you talk to us about what's the pipeline in terms of what are the malls that you're expected to come up with in the next 12 to 24 months?
See, we started our retail journey building malls in 2004, and probably, I think, and I'm sure that we built India's first organized retail center that was the Forum, under the Forum brand. And we built 8 of them, and then these were divested to Nexus, that is Blackstone. We divested 85% of our portfolio. That's why I said we are holding 3.5% of the entire bigger basket. And having done that, what we are doing now is, you see, because the younger generation's expectations, the requirements keep changing. So now we recently opened our largest mall in Bangalore, in South Bangalore. That is the Prestige Forum Falcon City. And that has done amazingly well. We were quite humbled with the type of footfall that we got in the first few months. And over 1 million people have visited the mall in just a few months. And that shows that there is demand for retail. There is people are wanting to get out and having the experience. And what we did is we came out with a brand new product. The look, feel, everything was catering to the now next gen, the younger crowd. So that is what is fueling this. And then, of course, we are opening a mall now in next month in Kochi. And I think we are looking at building our portfolio back again. We'll soon be, in the next 3 years, at least we'll be having 11 operating malls in various cities across the country and about 10 million square feet. And this will grow. I mean, we are not going to stop there. And ultimately, yes, if you have to get your cash out at some point of time, or you have to get some equity, we will do that. I mean, after all, all business is all about internal accruals, debt, equity, all of it. At the same time, we would like to build this portfolio in a better, bigger manner and create this social infrastructure, because there's a huge opportunity in the country for retail. And more than back from 2004 to now, another major thing is there are a lot more brands that have come in, both homegrown brands as well as international brands that have entered the country. And that is a huge offering for the youngsters. And it's a overall offering. It's just not about shopping. It's about the experience of food and beverage, about entertainment, cinema, all of it. So all rolled into one with the proper experience is what people are looking for. And that is what Prestige is planning to do under the Forum brand.
Okay, Mr. Razak, on that positive note, we let you go. Appreciate you joining us on the show this morning. But shifting focus for the markets, it seems like there has been a bit of a drop as far as the market goes, because the Nifty is just around that 18,100 mark. What's putting pressure on the... Okay, so there's a bit of a recovery from the lowest point as well, 18,127. In terms of stock-specific action, pull up a Gland Pharma with a cut of around 20%. Then the Adani group of companies are trading with cuts of anywhere between 4 to 5%. And then a lot of result reactions like GR Infra projects, which are in focus as well. But talking about result reaction, that's something that we are seeing on Minda as well. Let's try and decode the Q4 performance and the outlook going forward. We have with us Mr. Sunil Bora. He's the Executive Director, Group CFO for Minda, joining us on the show. Sunil, hi, thank you so much for making time and speaking with us. Well, I wanted to begin by understanding what's the demand situation on the ground, because for now, the revenue breakup is tilted towards four-wheelers, which has almost 55% of your revenue contribution. How's that mix likely to shape? What's the demand trend on ground when it comes to two-wheelers?
Yeah, good morning. So in terms of demand, we have seen month on month there is improvement in current quarter also. The volumes for both two-wheeler and the pass car segments are better. We know that the OBD2 norms have just kicked in from 1st of April, so there has been some volume impact in terms of production in Q4, but it has now back in terms of volumes in the two-wheeler segment. PV segment also continues to be robust. While in some pockets there is still some challenge in terms of the semiconductor issues, but they are in patches, so nothing much to worry about. But yes, there is some impact. But if we see the trend consistently has been on a positive side. In the pass car segment also, if we see, we have been consistently able to increase our kit value. If you would see our kit value across segments, across categories, we have been able to do a much better in terms of growth year on year. And if you see the trend for last 4 years, there has been significant addition in the kit value. So in terms of overall pie, as you asked, definitely we do expect that tilt more towards PV versus two-wheeler, while two-wheeler segment is also doing well. But the more business we have added is from pass car perspective. In two-wheeler segment, as you know, we have added a lot of new products in terms of our EV basket. So we do expect two-wheeler also to catch up fast as the penetration for two-wheelers gather space.
Right. Mr. Bora, could you talk to us a bit more about that EV portfolio that you just highlighted? What's the order value, order book looking like? What are the trends that you are seeing? What kind of growth rate do you envisage in the EV vertical?
Yeah, so in terms of EV vertical, we are already having orders worth more than 1,000 crores per annum. We've been consistently adding a lot of businesses. If we see the last quarter itself, the EV volume as part of the total EV volume in two-wheeler segment was roughly 4.5%. But in terms of our revenue is almost 8 to 8.5%. So the delta which we have been expecting, it's clearly visible in terms of higher revenues from the EV segment. The kit value which we had for IC engine was roughly around 8,000 rupees per vehicle, which grows to almost 35,000 rupees per EV two-wheeler, which is already in production or something will get into production within this year. So in terms of kit value, we are expecting a significant ramp up. And as we move to the next year, we will be commissioning our EV motor plant in second quarter of this fiscal. And also we will be sort of commissioning a lot of our products in terms of our EV JV with Freevo. So both these products also will get kicked in from second quarter. So we are expecting a significant bump up in terms of revenues in the two-wheeler segment as the volumes also grow, and we also keep on adding more and more business to our kitty.
Is EV business more like a business where you're moving because you need to hedge your portfolio, or is EV business something which is strategically important for you because that is a high margin business?
I won't talk about comment on margin immediately because volume is less, but I can tell you strategically, we first of all do not have any significant risk when we move from IC engine to EV portfolio. So if you see our products, our businesses, we have no product in our top line which has got any significant risk of transitioning from ICE to a EV. So for us, EV, we have been taking more as an opportunity than a threat. And that is why we have been consistently building a portfolio of products in the EV segment, which is you can say unparalleled in the industry. And in terms of the existing products, there are only two products into our joint ventures where you don't see a consolidation at top line, which is the CNG kit and the filter, which has some risk, obviously, because they don't have application into EV. But all other products, be it lighting, be it seating, be it blow molding, be it airbags, infotainment, switches, everything, alloy wheels, everything will have application in both ICE and EV. So from that perspective, it's not a threat. Actually, it's an opportunity for us.
What would be the turning point when you would say that my EV business is more than ICE engine or ICE business?
Yes. So that's what I was trying to say a little while, that if you see the Q4 result itself, where not all of our EV products are in operation and not that all the EV business is locally sourced. There are OEMs who are still importing some of the components. So it is not that 100% in India. But despite that, if you see our total revenue of two-wheeler segment for past Q4, and of that, if you see the volume which are going into EV, it is almost 8.5% of revenue, whereas the EV penetration of total pie is only 4.5%. So that's the delta you are seeing. If we would have been only in the old existing businesses, maybe we would have been in line with the industry 4.5%, but actually it is like 8% plus. So that's the shift I was trying to say that we are expecting in terms of migration from IC engine to EV, where not only your existing products, but also the new products gets into play.
Bora, as we wrap up the conversation, wanted your sense regarding the outlook for FY24. You ended the year FY23 with a revenue growth of 35% at a revenue profile of 11,000 crore and margins were close to 11%. Come FY24, what would these numbers look like?
Yes, ma'am. So, you know that we normally don't comment on the top line. What we say is what is in our hand, because 90% of our revenue is directly going into line fitment to our customers. So we don't second guess our customers. But if you see from industry volume perspective, this year industry have grown by roughly around 13%, whereas we have grown by 35%. And that has been our endeavor. How do we consistently outgrow the market? So if industry grows X, how do we grow 1.5X or 2X? And that has been our endeavor to consistently outgrow. So that's in terms of revenue. We do expect that outperformance versus industry growth to continue forward. And also in terms of margin, our expectation is we will hold on to this margin range, which is in the top quartile of the industry, which is between 11 to 12%, which the guidance we gave for the last year. We are holding on to the same guidance for the next year as well.
Okay, so on that optimistic note, we'll let you go. 11 to 12% margin band is what you're expecting, and good luck for maintaining that industry-leading growth when it comes to the top line as well. We'll let you go, Mr. Bora, on that note. For the market, below the mark of 18,100, so another slip is what has come into the markets at this point of time. Having said that, it's the AMC stocks which are coming under pressure. So HDFC AMC is down about 3%. Aditya Birla AMC is also seeing a bit of a cut. So all of these counters are in focus on account of those slew of changes that Sebi has proposed at this point of time. New listing is also expected to happen at 10 a.m. But before that, it seems it's going to be a positive listing with a gain of around 3%. On that note, slipping into a very short break. Don't go anywhere. Welcome back. Well, market under pressure, and at the index level, it's UPL, which is down 2%. Tata Consumers is seeing a bit of a drubbing. Then you have Hero MotoCorp, Britannia, ITC. All of these FMCG stocks are on the back foot today. What's standing out, interestingly, is IT today. So Infosys is your top gainer at the index level. HCL, Tech Mahindra, TCS. These are your top 4 gainers at the IT Nifty level. So these are the counters which are doing well. Nasdaq, of course, has been reacting positively. Has been sitting at August 2022 highs. So perhaps a bit of a rub-off impact happening back home as well. So Nifty IT is one of your top performing sectors this morning. But what's not performing is Gland Pharma. The numbers were dismal, and accordingly, we are seeing a negative reaction on the stock, stuck in lower circuit with a cut of around 20%. Let's go across to Sharad to get the key highlights of the internal. Sharad.
Well, yes, in focus we are having Gland Pharma, and came out with a weak set of March quarterly numbers. The revenue fell almost 30%, and looking at the margins, that fell almost 1,000 basis points. Now, overall, if you look at it, the margins were impacted because of higher employee and other expenses. But on the other side, if you look at it, the gross margins did expand by 300 basis points due to the lowering of raw material costs. Apart from this, a 56 crore rupees adjustment was there for the impairment of financial assets. And also, if you look at the segmental performances, the core business, which contributes roughly 70% of the total sales, that fell almost 23% on a year-on-year basis, while the India business fell 68% and the rest of the world fallen by 10%. But now let's look at the key triggers for the stock and what lies ahead for the company. And of course, the company is focusing on building biosimilar CDMO projects and also in the manufacturing of the injectables. And this quarter itself, the company actually closed the acquisition of Cenexi, and this happens to be the first overseas acquisition. And management has remained bullish because of the synergies which are expected to come in because of this acquisition, and the company itself is prepared to launch new products, the first initial batches in the China market as well.
Thanks, Sharad, for that. That stock seeing a bit of a cut of around 20%, but there's a new listing on the block, new kid. Let's try and see how the listing has been, because the issue price was around 100 rupee per share. The total issue size was 3,200. We had seen quite a bit of interest in this counter. The total subscription was around 3.6 times, with our institutional investors portion being subscribed 3.3 times, and that stock is listing with a positive bias, not by a whole lot, but at least a 3% gain coming in despite the weakness in the market that we have. Those are the visuals for you coming right from NSE, wherein the listing is happening at this point of time. Smiles everywhere because the listing has been on the positive side, 3% higher, in fact 4% now, despite the weakness in the market that we are witnessing at this point of time. Of course, this is a REIT which is coming in. They have a lot of malls that they own. Select City Walk is one big name that everyone will identify with. The total portfolio is around 17 malls in 14 cities, and that's the new listing for you. Nexus Select Trust opens with a gain of almost 4%. Okay, so that was Nexus. Let's pull up actually Prestige Estate as well, because we were just speaking with the management and they were talking about how they have a minor stake in that particular company as well. Let's see if it's reacting positively at all. Prestige Estate is the stock that I'm talking about. It's not expected to change the prospects of the company by a whole lot, but nonetheless in focus. But shifting focus to the company that everybody wants to hear about, and that's Jubilant FoodWorks. That's the big interview that we have lined up for you. It's been in the center stage because of the entire focus that we're seeing in the QSR space. Managing Editor Nikunj Dalmia caught up with Jubilant FoodWorks MD and CEO Sameer Khetrapal. Listen into that riveting conversation.
There are a few short-term pressures that I see, driven by inflation, driven by some of the pent-up demand that you saw post-COVID normalizing. And as I see the inherent latent or inherent demand in our economy, or what consumers are looking, is over a medium to long term is super robust. So I am not too worried about the short-term changes. I think the tide should turn around very quickly. Because of high inflation, price increases, consumer made choices towards lower ticket sizes, or they moved from a large pizza to medium pizza. But as inflation kind of stabilizes, I do expect this to bounce back relatively sooner.
Do you expect a bounce back in this year itself?
Yes, I think the later half of this year should see, because the base effects of higher inflation will be normalized, and therefore it should lead to more discretionary spending. I'm talking about the macroeconomic in general, but Nikunj, I do want to point to the fact that while yes, you do see short-term mix changes and consumers downgrading, the whole market is like the $50 billion, right? One eating out market is $50 billion, and pizza as a category is about $1 billion. So to me, the competition is, or the opportunity is far bigger than how we slice and dice the market, to be honest. So I'm more focused on internal driving technology, building the commissaries, opening stores, making sure the experience is great, launching the 49 rupee pizza to a gourmet pizza at 6.99. I think there is enough opportunity that my team is focused on, and that's what like keeps me exciting rather than a little bit of worrying about some of the macroeconomic things.
Fair point. If I look at the same store sales for Jubilant FoodWorks and for Pizza Hut, there seems to be a decline in the pizza demand and there seems to be an uptick in burger demand. What is your view on the pizza category growth per se? Because that is the big question which perhaps we need to understand and address.
Sure. No, I think I will answer your question again. Firstly, the overall QSR or organized QSR as a service is minuscule when it compared to eating out. So it's less than 2%, and the competition is not necessarily with Pizza Hut or some other pizza selling chain. It is also with a samosa and a vada pav and an idli and a sambar, right? Because that's where the large market is. Now, having said that, coming to pizza specifically, cheese has been a decadal high in terms of price. There was huge, we face unprecedented inflationary pressures on oil, on wheat, and therefore everybody took price hikes and passed it on to the consumer while also looking at internal efficiencies. So I see this category to continue to grow at anywhere from 13 to 15%, maybe higher, once some of the bases normalize. And it is more to do with the price hikes the industry has taken because of unprecedented decadal high prices that we saw. So it should get normalized very quickly, in my opinion, and pizza will continue to grow healthy double digits.
Jubilant FoodWorks is always identified as a pizza delivery company, but I look at Jubilant FoodWorks differently. For me, it's a company which owns an independent supply chain, has experimented in the biryani space, has got a Chinese business and has got some global investments. Could you just share with for our viewers that at percentage of the total sales for Jubilant FoodWorks, how much is coming from pizza, and do you see that number changing going forward?
Yeah, I think we don't disclose segment-wise revenue, Nikunj, but of course, large majority of our revenues come from pizzas, and the other businesses are very small and nascent. So Popeyes is just 1 year old. We repivoted our model from Dunkin' to Coffee First, which is a very fast-growing market, and we are growing Hong's as a first Indian brand or an in-house brand, as we call it, and then looking at opportunities outside of India. But so majority of the revenue does come from pizza, but the opportunity again remains. I think chicken is a large market. Popeyes is some outstanding product and customer feedback. In Chinese, there is no organized player, and coffee as a market is expanding rapidly as consumption grows in India.
I'm looking at some of your recent acquisitions in last 2 years. You acquired 10% stake in Barbecue Nation. You have invested 35% stake in a Mumbai food tech company. You acquired a stake in a Netherlands-based food company. What is the thinking behind putting these small stakes strategically, or you think these are the businesses which are future businesses, you would be scaling them up?
So great question, Nikunj, and I think I look at this strategically, and like any other business or a leader in this space, we have to, in line with our strategy, I want this company to be ops and tech focused, right? So therefore, you will see certain investments in technology. The second pillar is we are here to serve consumers in emerging economies. So there are like 6 billion out of 8 billion people in the world, or even more than that, actually reside in emerging economies. So what the playbook for Domino's, which is focus on value, great customer experience through delivery excellence, and an outstanding product, this playbook to me is very applicable outside of India in emerging economies. We've built a strong technology backbone through our own app, where we get more than 11 million monthly active users. We have 13.5 million Cheesy Rewards loyal members who are coming back and asking for more pizzas. So when I look at this backbone along with the supply chain and the commissaries that we have, that is a very compelling proposition. We will strengthen the technology, we will strengthen the cuisines or occasions to serve the consumers in emerging economies, be it chicken. And so I view this more strategically. And of course, we have to be patient. When I say strategy, it takes a 3 to 5 year for these investments to pan out.
Missing piece in your portfolio, perhaps you've got pizza, you've got coffee, you've got chicken, you've got biryani, you've got Chinese, is burger. The buzz in the market is that you are looking at making a small and a strategic investment even in Burger King or any other burger chain.
So firstly, Popeyes has an outstanding sandwich, right? And it is in fact known for its sandwiches, and whenever we open stores, we have lines of customers who line outside our stores to have that classic bold Cajun sandwich from Popeyes. We have no plans to invest at the moment in any other burger chain.
Thank you for that clarification. Now, my next question is about what we are discussing with you on numbers for the quarter gone by. That is January, February, and March. We are in March end. So almost halfway done for this quarter. How is this current quarter looking like? I think popped out, and I'm just going to tell our viewers then typically my guests here so that they can hear my voice.
Sorry, this
no problem. I think I complete this live television, sir. You can hear me. Would you like to adjust it? We've got all the time. You've caught us at a,
yes.
The only thing is this conversation is making me hungry because it is lunchtime for you and me both.
I hope you order pizzas during this for your lunchtime, and we'll deliver you in 20 minutes hopefully. So no, I think I would say this the price hikes that we've taken, or the industry has taken, some of the consumers feeling the pressure of these price hikes. It is, I would say, take some time for demand to bounce back. So therefore, what we are doing, we are seeing the seasonal uptick that happens because of IPL or from Q4 of financial year into Q1. Those obviously we are seeing it. Equally, we are focused on the internal opportunities that we are seeing in white spaces in the existing cities, and also expanding to newer cities. That we have given a guidance of 200 to 220 stores that we will add this year. We are on track to do that, and equally using our the loyalty program, our app downloads. Those pieces we are more focused on, Nikunj, and I think once the LFL growth comes back, we will have I think a very good story over here.
headlines emerging from that conversation, and the other headline that we are tracking in the QSR space is the kind of divergent move that we are seeing in pizza versus burger preferences, because pizza is something which has been showing quite a bit of slowdown, whereas you have the burger names which are doing better, and that's quite indicated in the performance as well, because for instance for Sapphire we saw the same store sales growth declining by 4%. It was similar case for Devyani with a cut of almost 3.2%. But if you look at the KFC performance and the performance of Restaurant Brands Asia or Westlife Foodwork, they have reported a solid growth of around 10 to 14%. Nikunj, what do you make of this divergence, pizza versus burger? Are you ordering perhaps burgers more?
I'm not eating both right now.
Both.
But yeah,
We'll have to look at some healthy chains now.
No. I mean, do I prefer a pizza or a burger? It's always pizza for me personally.
I think same for me.
Yeah, I mean, come on, pizza is pizza.
Yeah.
Burgers cannot replicate it. And vada pav is there now.
Yeah, of course, we have our own desi vada pav, and why look at burgers?
Exactly.
I don't think, though, the Burger King management will like this commentary from us.
No, but the numbers for the entire burger chains for the quarter gone by, and we are looking at a very myopic kind of a number.
Yeah.
McDonald's numbers are doing very well, which is the Westlife franchise. You look at Burger King, their numbers are doing very well. Similarly, Jubilant is suffering because of high, is suffering in terms of the same store sales. You have the competition, I think, in the pizza space has only intensified. Whereas in the burger space, it is still not that intense. And that space, see, in the entire pizza chain, Nisha, there is this gourmet pizza, there is this QSR element, and then there are these niche pizza restaurants. Sure. Within the burger space, you've not really migrated up to what is called as a gourmet burger. The first go-to space in India and both globally for the burger space are still the QSR restaurants. Right. And I think that's a differentiating factor. In a pizza, you've got a range. In a burger, it is still very basic, which grows.
Yeah, and also the fact that cheese prices have increased quite a bit, right? So the margin for these companies have also quite been substantially hit, because cheese, of course, forms almost 40% of the product value when it comes to pizza. It's a lot less for burger, and as we pointed out, it's the fact that there's a lot of standalone stores as well which are there in pizza category versus burger category seems to be eating the share of these pizza makers at this point of time. So that's the deep dive as far as the QSR space is concerned, but we'll take a further deep dive into the markets, but after this very short break.